Hello and welcome to this session. This is Professor Farhat. In this session, we're going to learn about basic definitions and terms that deal with cost accounting and managerial accounting. The first thing is we're going to learn about is cost. What is a cost? A cost is incurred when a resource is used for some purpose. So basically you are spending or you are consuming something for some other purpose, to serve a purpose. What's going to happen is we're going to differentiate between two types of costs. We're going to call one cost as a period cost and the other cost as a product cost. So the first thing we want to differentiate is we want to know what is a period cost and what is a product cost. Now, one way to look at period cost and product cost is when does period cost and when does the product cost hit the income statement. So let's start with a period cost. Easy. The period cost, if we have a period cost, it hits the income statement very directly. It hits the income statement quickly, immediately. So once we incur that cost, IS for income statement, that cost hit our income statement immediately. Okay, what could be an example? It could be administrative cost, salaries for your HR, maybe any cost that incurred that's not related to production. And we'll look at more examples in a moment. Product cost is a cost that go through several stages before it hits the income statement. So it doesn't hit the income statement directly, it goes through some stages. So what are those stages and what do we mean by those stages? Well, product cost is a cost used in manufacturing the product or buying the product needed for resale. So for example, for a manufacturing company, the first thing they do is they buy raw material. So when they buy the raw material, they don't expense the raw material. The raw material sits in a warehouse somewhere until we start manufacturing. From raw material, once we take the raw material, we're going to transport this to work in process. Then we're going to start the production process. Then the raw material becomes work in process. Then after work in process, we're going to have finished goods. This is when we manufacture whatever we are manufacturing. Then after we manufacture it, we are going to sell it. And once we sell the finished goods, it becomes cost of goods sold. And this is where product cost hits the income statement. So notice it did not hit the income statement until after several steps. And if you remember from your T account first, if you look at it from a T account perspective, we have raw material. And when we purchase raw material, let's assume we purchase 200 of raw material. Then raw material will go up. It's an inventory. It's an inventory account. Let's assume of that raw material we issued 150 for production. So we're going to reduce raw material and transfer 150 to work in process. Then from work in process, we are going to finish 100 of that work, just for the sake of the illustration. Then 100 goes to finished goods. Then after finished goods, once we sell this product, the 100 goes from, let's assume we sold everything, goes from finished goods to cost of goods sold. So this is where it hits the income statement. So this is one way to look at period cost and product cost. It's when does it hit the income statement. So the period cost hit the income statement immediately, and we're going to see a little bit more about period cost and product cost, but this is a general idea. So one way to look at it is when does it hit the income statement. So what is the definition of a product cost? Just to kind of make sure we know the official definition or a formal definition. It includes the cost necessary to complete the product at the manufacturing step in the value chain. So what's the value chain? It's the steps that you go through to manufacture the product, or if you are a retailer, to purchase and transport the product to the location of sale. For example, if you're a merchandiser, first you buy the inventory, then inventory becomes cost of goods sold. So inventory is considered a product cost. Well, period cost, on the other hand, also called non-product, to differentiate that it's non-product, include all costs incurred by the firm in managing or selling the product. So it has nothing to do with the product itself. It's outside the manufacturing steps of the value chain. So the period cost has nothing to do with actually manufacturing the product. So I want to show you this picture to show you how this works. I want you to look at this picture on the next slide. I want you to take a look at this picture. Okay, and I'm gonna draw a line here. This is our manufacturing plant. This is where we manufacture the product. And this is where the CEO, the CFO, HR, payroll lives. So let's keep them separate. Everything that goes on this end, on the manufacturing plant, we're gonna call this product cost. So product cost is the cost to manufacture the product. Now we're gonna see what goes under product cost, but this is what I want you to think about it. Everything that goes in this building, we're gonna call it period cost. It's the cost to support the process. It has nothing to do with actually doing the work. Notice these individuals right here, they are actually doing the work. Okay, they're actually doing the work, and we're going to name them something shortly. They're going to be called direct labor. And those people here, the CEO, the CFO, the top management, are planning for the work. So they're not really doing the work themselves. They are planning for the company. They are strategically planning, but the people on the front line, they're doing the work. So anything that goes on this end is product cost. Anything that goes on this end, it's period cost. And what do we do with period cost? Period cost is expense. We expense it. Product cost, it's inventoriable cost. Inventoriable, it means it's an asset. We inventory it until we sell it. So we're going to come back to this slide in a moment. So what are considered product cost then? Because we talked about product cost. So product cost goes on this side. This is where product cost is. So what's included under product cost? The first thing is direct material cost. When we want to manufacture something, we need material. So product cost of material that can be readily traced to output, equal to the purchase price of the material plus freight minus any discount plus reasonable allowance for scrap and defective units. So when we are manufacturing these boxes, let's assume we are manufacturing these boxes. Okay, if that's what we're manufacturing, just manufacturing boxes. If that's the case, the boxes themselves are the direct material. Direct material. It means we need the material to manufacture the object. Okay, so those are the direct material. The other thing that's considered product cost is direct labor. Labor that can be readily traced to output. And notice we kept saying readily trace. It means you can easily trace it to output, such as wages paid plus reasonable allowance for non-productive time. So what will be considered direct labor? Sometimes it's called touch labor. So this is the direct labor, or sometimes it's called touch labor. And the reason it's called touch labor, because those individuals are actually, notice they are touching the product, so they are working on the product. So what do we say? We say product cost consists of direct material that can be easily traced. They can be easily traced, and direct labor, which is again labor that's working on the product that can be easily traced to the product. So those are two parts of product cost. In addition to direct labor and direct material, we have indirect labor cost. Labor cost that cannot be readily traced to output. They are manufacturing supporting cost. Example would include supervisor, supervision, quality control, and inspection. So let's go back to that picture. Now you might have an individual standing right here who is supervising this process. Well, is this labor? Yes, but this individual here is a supervisor, and the supervisor is not touching the product. So we call the supervisor cost indirect cost. Nevertheless, it's still product cost, but it's indirect cost. Let's assume this individual here, you can barely see him. This individual here is a security guard for the manufacturing plant. It's a security guard, but it's working at the manufacturing plant. Guess what? This security guard is indirect cost, and it's indirect labor, but it's also part of the product cost. Now, if this security guard is working in this building right here, it becomes a period cost. This is a janitor right here. You can barely maybe see this, but there's an individual standing here, and this is the janitor for the manufacturing plant. The janitor is also indirect labor, but indirect labor is considered manufacturing plant. Let's assume we have a janitor for this building, and most probably we do have a janitor for this building. This janitor is considered a period cost. So hopefully you are differentiating between period and product, and between direct labor and indirect labor. So this is indirect labor cost. You might also have indirect material cost. That's also part of the product cost. Cost of the material that cannot be traced to output, such as lubricant, small tools, rags, so on and so forth. Okay, let's assume we're putting these boxes together and we need to use glue. We need glue to glue those boxes, to glue the whole box. Well, the glue is part of the box, but the assumption is it's not worth keeping track of the glue because it's not readily traceable. Therefore, the glue is called indirect material. Okay, indirect material. And remember, the supervisor is indirect labor. So indirect material, indirect labor, they're part of the production cost. And obviously direct material and direct labor are also part of the direct cost. Any cost incurred here in this building, utilities, depreciation, insurance, taxes, anything that's incurred here is considered a manufacturing a product cost, anything that takes place here. Okay? So all indirect costs for the manufacturing, including indirect material, indirect labor, the janitors, the security guard at the facilities, the supervisors, other indirect items are often combined in a cost pool referred to as overhead. So what is overhead? So if I ask you what is overhead, here's the definition for overhead. Anything but direct material and direct labor. And anything, I mean anything that happened in the manufacturing process, obviously. So any cost incurred in the manufacturing process but direct material and direct labor. Because direct material and direct labor, they are also part of the product cost, but we treat them separately. So we have direct material, direct labor. So let's summarize. We have direct material, direct labor, manufacturing overhead or just overhead. And under manufacturing overhead, we'll have indirect labor, indirect material, as well as other costs that takes place in the manufacturing plant, and many other costs for that matter. So we call it overhead, factory overhead, indirect manufacturing cost, and I usually call it manufacturing overhead, MOH. Okay, so those are all product cost. Now, we need to be familiar with other terms. So the three main type of costs are direct labor, direct material, and overhead. Okay, remember under overhead you have indirect labor and indirect material. They are even condensed further. What we can say, we have a term called the prime cost. Prime cost is direct material and direct labor. So DM plus DL, and you will see we're going to be using this term throughout the course. And there's another term called conversion cost. It's DL plus overhead, manufacturing overhead, equal to conversion cost, because you need labor and overhead to convert the raw material into finished goods, and you need labor and material as a prime cost. Basically, you need them mainly to manufacture the product. Okay, so this is hopefully now you understand the difference between a product cost and a period cost. Remember this picture here. Remember, this is period. Anything that take place here is period cost and its expense. Anything that takes place on this side, on the manufacturing side, it's considered product cost or inventoriable cost. Another topic we need to look at is cost behavior. And cost behavior is a key concept in cost accounting. So how does cost behave? Well, we have various types of cost behavior. The first one is fixed cost. What is fixed cost? Fixed cost basically state in total, the cost stays the same. So whatever we are doing, whatever we are producing, we have that fixed cost, and that fixed cost stay the same. For example, we might pay a rent to manufacture our product, a rent for $10,000. So what happened to the rent cost per unit? So let me show you how it works. So fixed cost, it means we have a cost of $10,000. And assuming we produce 0 boxes, if we are producing boxes, we still have to pay the rent. If we produce 0 box, so this is the cost, and this is the unit. Sorry. If we produce 0 box, we have to pay $10,000. This is the cost. If we produce 100 boxes, we still have to pay $10,000. If we produce 200 boxes, we still have to pay $10,000 for rent. If we produce 300, same. 400, the same. So if we graph this, this is what the fixed cost would look like. And it's not forever fixed, but we're going to assume it's within something called the relevant range. It means fixed cost in total. Notice we have to pay 10,000 in total. So in total, it stays the same. So the rent is 10,000 and it's in total, it stays the same. Let's unitize this. What happened when we produce 100 boxes? When we produce 100 boxes, what's going to happen is this. We're going to say $10,000 divided by 100 box. It's costing us 100, our fixed cost per box is $100 per box, right? Let's assume we produce 200 boxes. If we produce 200 boxes, now it's costing us $50 fixed cost unit per box. If we produce 1,000 boxes, now it's costing us $10 of fixed cost per box. So notice, as we produce more, our cost per box, our cost per unit goes down. So notice your total cost stays the same. So this is important. So stays the same. In total, it stays the same. Stays the same in total. I have it twice. If we want to compute our total cost per unit, our total cost per unit goes down as we produce more. As we produce more, our total cost per unit goes down. But this is not a variable cost. You're thinking because it's changing. It's not really changing. We still have to incur $10,000, but our cost per unit, because we are producing more, our cost per unit goes down, but total cost stays the same. Okay, hopefully you see this picture. So this is the fixed cost. Variable cost, in total it changes and per unit stays the same. So what does that mean? Okay, let's assume it cost us indirect, just for the sake of illustration, it cost us indirect labor plus direct material $2 to produce one box. So it costs us $2 to produce one box. Indirect labor, $1 indirect labor to be more specific, and $1 indirect material. I just gave you these numbers. So it costs us $2 to produce one box. Here's what's going to happen. If we produce one box, so this is the unit and this is the cost. If I produce one unit, it's going to cost me $2. If I produce 2 units, it's going to cost me $4. If I produce 3 units, it costs me $6. If I produce 4 units, it's going to cost me $8, so on and so forth. So notice what's happening. Per unit, my per unit, it's constant. My cost is constant per unit, $2. Now, if I produce 4 units, I incur $8. Total increases. So my total changes as I produce more. If I produce 4 units, my total cost equal to 8. If I produce 5 units, my total cost becomes 10. It goes up to 10. So the total cost changes, but per unit it stays the same. So make sure you know the difference between this. So variable cost, in total it changes. In total it changes, but per unit it stays constant. Per unit it stays constant. Now, this is what it looks like. Okay, variable cost, if we graph it, it graphs something like this. If this is the cost and this is the unit, if we produce 0 unit, we have 0 cost. As we produce 1 unit, we have $2. If we produce 2 units, we have $3. So as we produce more units, we have more cost. As we produce the 4th unit, it goes up. So this is, so when we graph it, the graph looks like this. Okay, so it goes up as we produce more units, but it's constant per unit. So this is variable cost. We have another cost, it's called mixed cost, and most costs are mixed because most costs, they are not 100% variable, they're not 100% fixed, they are mixed. Mixed means part of the cost is fixed, part of the cost is variable. For example, your electric bill. For example, if you have an electric bill, most probably what's going to happen is you might have to pay per month maybe $8 per month. I pay $8 per month. Regardless, if I don't use my utilities at all, I still have to pay $8. Okay, this is $8. Then, as I consume more electricity per kilowatt, I pay more. For example, for each kilowatt, let's assume $1. So if I produce 1, It's going to give me 1 kilowatt, another dollar, another kilowatt, another dollar, so on and so forth. So a mixed cost would look something like this. This is the fixed component. This is the fixed cost. And this is the variable. This is the variable. This is the variable component. So this is what a mixed cost would look like. Okay. Now we're gonna learn more about mixed cost later on during the semester or during this course. But this is just an introduction to it. And we're gonna find out how to break down mixed cost into its fixed and variable component. One more cost we're gonna look at is a couple more. Step cost varies in steps. What is a step cost? A step cost, it looks like a variable cost, but it's not really variable. It's a step cost. For example, you would start at to produce 10,000 boxes. Let's assume 1,000 boxes. To produce 1,000 boxes, you guys remember the rental. I need $10,000 in rent. Okay, so I can, with $10,000 rent, I'm gonna make it 10,000. I can produce 10,000 boxes. So for 10,000 rent, I can produce 10,000 boxes. 10,000 boxes. But if I want to produce one additional box above 10,000, if I want to produce one additional box, I need a whole new manufacturing plant. Therefore, I have to rent another manufacturing plant and my cost goes up. Okay, so if I want to produce one additional box above 10,000, I have to incur an additional 10,000. I'm up to 20,000 in rent. So I can produce, with $20,000 rent, again, I can produce another $20,000 in boxes, 20,000 boxes. But if I want to produce an additional above $20,000 boxes, I have to again rent another space, and my cost will go up. My rental cost will go up to 30,000. And with 30,000, I can produce up to 30,000 boxes. And if I want to produce one additional box, my rent goes up to 40,000. And this is what a step cost is. It looks like variable, but it's more steep. It just basically, my cost goes up dramatically. Another concept we're going to be working with throughout the semester is sunk cost, cost that has been incurred. And what do we need to know about sunk cost? Sunk cost, it's irrelevant to most decision. We bought something in the past, and that's it. We can no longer change that decision. It's considered a sunk cost. Therefore, when we are making a decision now, we ignore it. And we'll talk about sunk cost later on when we are making cost decision. And this is how fixed cost and variable cost work. I showed you an example with numbers, but this is another number. Let's assume we are dealing with a fixed cost. If we produce 10,000 units, our total cost is $100,000. Our cost per unit is $10, which is 100,000 divided by 10,000 units. If I produce 20,000 units, my total cost is still 100,000. But my cost per unit goes down. Why? Because now I have 100,000 and I produced more units, 20,000. Therefore, my cost per unit, my fixed cost per unit is 5. So notice, the total is constant. So the total is constant. Okay, the total is constant. But per unit, it decreases, it changes. Per unit, it decreases. So this is the fixed cost. Let me change my pen to talk about the variable cost. Let me change a different color here. I'll use the black. Okay. Variable cost is this. Let's assume I produce 10,000 units and my cost per unit is $8. So 10,000 times 8 equal to 80,000. So this is my total. If I produce 20,000 units, it costs me $8 per unit. My total is 160. So notice, my total increase or changes, that just increase, but I'm just going to make the total changes, but per unit, it stays constant. So know the difference between these two relationships. And this is the total cost, which is fixed plus variable. And this is another graph of fixed cost. Basically, in this example, if I produce 0 unit, I still have to pay $3,000. Here, this is a mixed cost. If I produce 0 unit, I still have to pay 3,000. And as I produce more units, I have more cost. And this is a graph of a step cost. So I can fill to up to 100 order, for example, by paying $1,000. Now, if I want to fill one additional order, 101, that's it. I don't have the capacity. Therefore, I have to hire maybe another individual and have to pay them $1,000 to produce that 1 unit. And I can fill in, once I pay this much, once I pay this additional 1,000, which is I'm up to 2,000, then I can produce up to 200 unit, up to 200 orders. But once I need to produce more than 200, I have to hire another person, maybe pay them $1,000, so on and so forth. So this is a step cost. So hopefully this session helped you to differentiate between period cost, product cost, variable cost, mixed cost, and fixed cost. If you're studying for your CPA exam, if you're studying for your CMA exam as well, make sure to study hard, make sure to understand those basic concepts, read the book, complete your homework, and if you have any questions, email me or see me in class. Good luck.